This is a beehive, an intricate, decentralized network of thousands of tiny agents all working together. And this is the stock market, an equally complex system, made up of millions of human decisions happening in real time. At first glance, they seem unrelated. But beneath the surface, these systems have a lot in common. And, more importantly, they share a fundamental vulnerability, one that makes both prone to sudden, catastrophic collapse. In fact, some scientists think that by studying how bees behave, we might be able to better understand and maybe even predict when and how markets crash. Because when you dig into the science, you start to see it. Beehives and markets run on the same rules. This is the story of how biology might explain your 401k. A single honeybee colony can contain 20,000 to 60,000 individuals. But in the eyes of biologists, that number is irrelevant, because a beehive isn't a group of individuals, it's a superorganism. Just like your body is made up of individual cells, a hive is made up of individual bees working together to keep the colony alive. No single bee understands the big picture. No bee is in charge, not even the queen. But through simple rules and local interactions, a kind of emergent intelligence arises. Each bee has a job, and these roles shift depending on the needs of the colony. They communicate using vibrations, pheromones, and a waggle dance, a dance that encodes direction and distance, that a scout bee performs when she finds a rich food source. Other bees watch and follow. It's a self-organizing system. A hive doesn't need a CEO to make decisions. It operates through distributed consensus, and this is where it starts to sound familiar. Markets work the same way. No one controls the stock market. It's not a machine, it's a living network, a swarm, of millions of investors, each with their own incentives, goals, and information. But together, they produce a collective output, the price of a stock, or an index, or the entire direction of the economy. Like bees, traders follow signals. Earnings reports, news, trends, prices. The collective, waggle dance, of humans. And just like in the hive, small actions by individuals can trigger large-scale movements in the group. Both beehives and financial markets are complex adaptive systems. This means that they are made up of multiple agents, each following rules and reacting fast, producing unpredictable collective results. This kind of system produces emergent results, that is, results that go beyond the work of individual parts. Complex systems are resilient, meaning they can recover fast up to a point. But they are also fragile, and when they fail, they can fail catastrophically. So it is no surprise that early warning signs of collapse in biological systems also show up in economic systems. In other words, the way a beehive collapses can mirror a market crash. In both hives and markets, positive feedback can drive rapid change. In bees, when a scout finds a good site for a new nest, she dances again. Other scouts go check it out. If they agree, they dance too. This is efficient, but not foolproof. The more bees that agree, the stronger the signal becomes. Eventually, a threshold is reached, and the colony moves. If scouts prematurely overcommit to a poor site, the swarm can make a catastrophic decision. Now consider financial markets. A rising stock price attracts buyers. Those buyers push the price even higher, attracting more buyers. This cycle feeds itself, until it doesn't. This is how bubbles form and burst. The housing market in the early 2000s followed this pattern. So did tech stocks in the late 1990s. So did GameStop in 2021. In each case, individual actors responded to local signals, prices, momentum, social proof. The system amplified itself until it reached a breaking point. This isn't irrational behavior. It's emergent behavior, where the result is more than the sum of its parts. Just like in a beehive. There's a concept in ecology called critical slowing down. This concept captures a powerful idea, that as systems approach a tipping point, they become slower to recover from disruptions, and eventually, do not recover. And this applies both to beehives and to markets. It's intuitive. A strong organism recovers fast from external harms, while a weak system takes longer or may not recover at all even from minor injuries. Researchers have observed that when colonies are under stress, due to parasites, lack of food, or temperature fluctuations, they start to slow down in measurable ways. The time it takes for a colony to resume normal behavior after a disruption increases. Their internal coordination weakens. And eventually, the colony collapses. Financial markets show the exact same pattern. Before a crash, recovery times get longer. Volatility increases and small shocks have outsized impacts. These signs were there leading up to the 2008 crisis. Banks were exposed to risk, confidence was eroding, and yet the system continued until, suddenly, it didn't. If we had been looking for biological signals in the market, we might have seen it coming. When a beehive collapses, it often happens suddenly. One day, the colony seems healthy. The next, it's empty. This phenomenon, known as colony collapse disorder, is still not fully understood. But researchers know it's rarely due to a single cause. It's a combination: pesticides, parasites, poor nutrition, environmental stress. The system weakens slowly. Then, all at once, it breaks. Financial markets collapse the same way. A regional bank failing may not cause a crisis. But it may also trigger a chain reaction, and then the collapse becomes systemic. It will depend, in part, on how close to the critical slowing down tipping point the market is. The warning signs are often subtle, hidden in the noise, but they're there. And increasingly, biology is helping identifying the signs. Researchers are applying tools from ecology, used to study forests, coral reefs, and insect colonies, to analyze financial networks. These indicators have helped predict tipping points in natural systems. And now, they're being tested in financial simulations to forecast market crashes. Likewise, models originally used to study invasive species are now being applied to financial contagion, which is what happens when a market collapse spreads to other countries. Similarly, biodiversity fosters resilience in nature, and diversification spreads risk across asset classes. The idea is the same: diversity prevents collapse. But in both systems, when diversity dries up, the whole network becomes fragile. What can we learn? 1. Decentralized systems are powerful but fragile. Both hives and markets can adapt, but they're vulnerable to feedback loops and tipping points. 2. Local events can drive global outcomes. A bee's waggle dance might seem trivial, but enough of them, in the right direction, move the entire colony. A Reddit post might seem irrelevant, but with enough momentum, it can move the entire market. 3. Slowdowns are signals. Delayed responses are often a sign of rising stress, both for bee colonies and for the market. And finally, biology and finance have a lot in common. They're governed by the same dynamics: networks, incentives, information flows, and adaptation. Which means that if we want to understand how markets behave, we might do well to watch the bees. The market may not buzz like a hive, but it works with the same complexity. The challenge, and the opportunity, is learning how to listen.